The Toronto stock market recorded its biggest one-day sell-off in 18 months yesterday. A big chunk of that decline coming from oil sands stocks. The falling price of oil has created a bit of a quandary for Canadians heavily invested in the Canadian stock market. For today's Q&A, Som Seif, the CEO of Purpose Investments. Great to have you with us.
Great to be here, Amanda.
So our first question is, if I don't own oil stocks, what's my exposure to weak oil prices? And I think this is a great question. You can take it from two different points of view. You can take it as an individual in the world who consumes stuff, but as an investor, if you're not exposed to the actual stocks that are falling, and boy did they fall yesterday, what is your exposure here?
Well, first off, most people do have exposure to energy stocks. Right. They just don't know it. Maybe they haven't bought an energy stock in their portfolio, but you probably have a mutual fund, you have maybe an ETF, or you have your pension plan that is exposed to this, and so that obviously it is going to have a percentage of your portfolio that's in these assets, because Canada is heavily geared towards it. On the other side of it is, the economy. I mean, so Canadian economy has basically been geared towards mining, energy, and banks. And of course, commodities have been out of the, in the doghouse for a while. Energy is starting to really be in the doghouse, and banks, as we saw in the last couple of days, have been in a bit of a doghouse, all because the economy is a little bit geared towards the energy market. So, I think people are going to feel the effects broadly, both in their portfolios and also outside of it.
We did see double-digit declines for some energy stocks yesterday. In your view, is that an overreaction? If I happen to own Baytex or Penwest or some of the names that really sold off yesterday, do you just sit tight, or do you say, I just lost 18% of my value yesterday, it doesn't feel very good?
Well, the reality is that energy prices in Canada, there's a lot of leverage in these companies too. So with oil prices going down maybe $1 or $2 or $3, the actual impact is even greater for a company that needs a higher oil price, and when it goes below that oil price, they're actually losing money. So ultimately, it's a really bad scenario for those businesses, because they're not viable long-term businesses. And what we've seen is a lot of these companies are starting to think, okay, what are my long-term plans? Can I be a viable self-entity, or do I need to either sell assets or potentially do some kind of merger? And so we're going to see some of this activity in the next little while. My personal view is I think that oil prices could go further down, and moves like we saw in the last couple of weeks and months, I think could actually continue to see a little bit more of a slide.
I think one point you raised that maybe investors don't always consider if they're buying individual stocks, because to your point, many of us are exposed to the energy sector in this country through a broad index, or we can't really control it. We just bought the basket. If you own individual stocks, should you know where that price is at which they become unprofitable, so you know whether are you betting on $80 oil or $40 oil?
Well, I think when you buy individual stocks, you really should know what you're buying, and that's why it's really tough to be an individual stock owner, right? Because if you don't understand every element of your stock portfolio, then you ultimately you're just going to either buy the index stocks and look like the index, and it's probably not worth it. So my view is if you're going to be an individual stockholder, you better understand the fundamentals of the business itself that you're buying.
There's a related question. Our second question is, do disappointing Canadian bank profits mean it's time to lower my exposure to bank stocks? And again, you may not own individual bank stocks, but you certainly are exposed to them if you own an index, an ETF, any kind of exposure to the Canadian market.
Yeah, pretty tough for Canadians to not own a bank stock. In their retirement portfolios, in their core portfolios, everybody is littered with bank stocks. And so this is a real issue. So the banks have been wonderful companies to own for a long time, and it's really hard to tell people to lighten up on bank stocks, because it's been such a great part of a portfolio for better part of 20 years, and they pay such a great dividend yield. So for retirees, they've used them as great income sources. But the reality is the banks are changing. So the banks are no longer these great growth-oriented businesses. They are actually much more like a utility. They're being regulated differently post-2008, and the profits, as we saw in the last couple days, are going to be challenged, and just like we see in the U.S.
So it was a bit of a double whammy, right? You might say, okay, we do have these two sectors grossly overrepresented in the Toronto stock market, energy and financials. Yesterday, everything went down. TD had a horrible day because it's a warning about its future the next year or so. So from an investor point of view, one thing that struck me, Som, and you've obviously are pretty close to the Canadian investing public, and you've offered them over the time ways to invest more broadly.
That's right.
We don't diversify out of this country. We can now. There's no rules that prevent us from doing it the way there once were in our RSPs, and yet most Canadians, I would say, are overexposed to this market.
There's no question. And again, Canadians generally stick to what they know and what's been working for them in the past, and banks have worked for them. Energy prices have been going up and have been doing really well for Canadian investors. But there is an enormous need for both sector diversification in a portfolio. I'm a big believer that you can't just have name diversification, you got to have sector diversification, because it helps you manage through these cycles, because they will have cycles. I mean, oil prices prices will go back up. Maybe not next couple months, but in the next couple years, I do believe oil prices will go back up. But in the meantime, you're seeing, your portfolio decline. Banks, they'll look like utilities. They'll give you a good yield and maybe a decent amount of capital growth, but they're not going to give you the same type of 15, 20% type of returns that we've seen in the past. So we need to look at other sectors. U.S. market, broadly diversified. You've seen a different growth cycle. You see different sectors like technology and other things like consumer discretionary, industrials, that we just don't have in Canada.
Yeah.
You need to think about these in a
portfolio. So we need to diversify geographically as well as
no question.
by type of asset.
No question. And you think about it also from the risk of the Canadian dollar. I mean, you talked about oil prices and what are effects. Well, Canadian dollar has been affected by the lower oil prices and the commodity prices. So we as Canadians are becoming poorer unless we start to index ourselves to other assets around the world by buying sometimes U.S. assets or global assets.
Thanks, Som.
Great to be here.
Som Seif, Purpose Investments. Coming up, wages